Imagine you wake up tomorrow and your bank quietly announces a loss. Not a scandal. Not a crime. Just a loss. No sirens. No headlines screaming collapse. Your debit card still works. ATMs still hum. Life goes on. And that's the unsettling part. Because banks lose money all the time. Sometimes staggering amounts. And yet, most of the time, nothing visibly breaks. So where does the damage go? That question matters more right now than most people realize. Because the modern banking system isn't designed to avoid losses. It's designed to absorb them. To spread them. To bury them. And sometimes, to quietly hand them to someone else. Today, we're going to walk through how that actually works. Not in theory. Not in textbooks. But in real-world mechanics. Step by step. Calmly. Without panic. Because once you understand how banks absorb losses, you start to see why financial crises feel sudden, even when they aren't. Let's start with something simple. A bank is not a vault. Most people picture a bank as a giant safe. Your money goes in. It sits there. You take it out later. That image is comforting. And almost completely wrong. In reality, when you deposit money, the bank doesn't store it. It uses it. Your deposit becomes raw material. Fuel. It's lent out, invested, leveraged. And here's the first uncomfortable truth. Most of the money you see in your bank account doesn't physically exist as cash anywhere. It exists as promises. Promises layered on top of promises. This is where loss absorption begins. Banks operate on a system called fractional reserves. That just means they only keep a fraction of deposits available at any moment. The rest is working somewhere else. That system is incredibly efficient. It's also incredibly fragile. Because when loans go bad or assets fall in value, losses don't show up as empty vaults. They show up as accounting holes. And accounting holes are flexible. Let's say a bank makes a loan for $1 million. On paper, that loan is an asset. It boosts the bank's balance sheet. Now imagine the borrower starts missing payments. The loan is still listed as an asset, until it's not. Banks don't immediately admit failure. They reclassify. They restructure. They extend terms. They pretend time will fix it. This isn't fraud. It's standard practice. Because the moment a loss is formally recognized, it has consequences. Capital ratios drop. Confidence erodes. Regulators start asking questions. So the first line of loss absorption is delay. Time. Losses are stretched. Smoothed. Quietly amortized. But eventually, math wins. When a loss can't be hidden anymore, it has to land somewhere. And this is where the system gets clever. Every bank has something called capital. This is the buffer. The shock absorber. Capital is the money that belongs to the bank's owners, not its depositors. Shareholders. Retained earnings. Reserves built over years. When losses hit, they hit capital first. That's by design. In theory, depositors are protected because shareholders go first. Their equity absorbs the damage. If a bank loses $1 billion, the value of its shares drops. Dividends vanish. Executives get uncomfortable phone calls. This is supposed to be the market's punishment mechanism. And sometimes it works. But here's the irony. The bigger the bank, the less painful this process becomes. Large banks don't rely on one source of capital. They have layers. Common equity. Preferred shares. Convertible bonds. Subordinated debt. Each layer exists to absorb losses before the layer above it feels anything. It's like a financial lasagna of pain. And most people never see it cooking. But what happens when losses are too big for capital alone? This is where the system quietly shifts the burden. Banks don't operate in isolation. They are embedded in a network of other banks, funds, insurers, and governments. Losses move sideways before they move down. A failing loan isn't just a bad loan. It's collateral somewhere else. It backs a derivative. It's part of a bundled product. So when it deteriorates, the loss doesn't explode in one place. It diffuses. This diffusion is intentional. It reduces immediate panic. But it also makes accountability fuzzy. No single actor feels responsible. Everyone feels partially exposed. And that's dangerous. Because when everyone assumes someone else is holding the risk, no one prepares for it. Now let's talk about the most misunderstood tool in modern banking: liquidity. Solvency and liquidity are not the same thing. A bank can be solvent but illiquid, or liquid but insolvent. Solvency means assets exceed liabilities. Liquidity means you can pay today. During stress, liquidity matters more. If a bank faces sudden withdrawals, it doesn't need perfect assets. It needs cash. So where does it get that cash? Other banks. Central banks. Emergency facilities. This is where loss absorption becomes invisible to the public. Central banks lend against assets. Sometimes questionable assets. Sometimes assets no private lender would touch. The bank survives. The losses are postponed. Not erased. Postponed. And postponed losses tend to resurface later, somewhere else. Sometimes in inflation. Sometimes in currency weakness. Sometimes in public debt. Which brings us to the quietest absorber of all: society. When a banking system absorbs losses successfully, it often means those losses were diluted across millions of people. Lower interest on savings. Higher fees. Reduced lending. Slower growth. No single moment of pain. Just a gradual tightening. It's death by 1,000 basis points. And here's the uncomfortable math most people never see. If banks were forced to fully recognize losses immediately, many would fail. But if they're allowed to stretch losses over time, the system remains stable. Stable, at the cost of transparency. This trade-off is intentional. Stability is chosen over clarity. Almost every time. Now let's address the elephant in the room. Bailouts. Everyone thinks bailouts are dramatic rescues. Emergency votes. Trillions announced overnight. In reality, most bailouts are boring. They're regulatory exemptions. Accounting changes. Quiet guarantees. They happen before collapse, not after. And they don't look like free money. They look like liquidity lines. Swap facilities. Temporary programs that somehow last years. Losses don't disappear in a bailout. They are relocated. From balance sheets to public risk. And that's the real mechanism. The system doesn't eliminate losses. It decides who feels them, when, and how visibly. Shareholders feel some. Bondholders feel some. Depositors are protected, until they aren't. Taxpayers feel some. And everyone else feels the long-term effects. This is why crises feel unfair. Because they are uneven. Now zoom out. Why does this matter right now? Because global banking systems are sitting on assets priced for a different world. Different interest rates. Different growth assumptions. Different risks. When conditions change fast, losses appear faster than systems can absorb them. And when absorption fails, confidence breaks. Not because the math is suddenly worse, but because people realize where the losses actually are. Banking crises are not math crises. They're trust crises. The math was broken long before the panic. The panic just reveals it. Here's the quiet irony. The more sophisticated the loss absorption mechanisms become, the harder it is for anyone to see risk clearly. Complexity creates calm. Until it doesn't. So the system survives. Again and again. By spreading pain thin enough that no one screams loudly enough. Which leads to the final question. If losses are always absorbed, if they're always shifted, if stability always wins over transparency, then what does safe actually mean? And when the next loss arrives, because it always does, who absorbs it this time?